How do you see silver going forward relative to gold?
Um, the interesting thing is that silver is, despite its recent move, it is priced almost exclusively as an industrial metal. Um, there is no doubt that it has got monetary qualities, which, in the circumstances which we've been discussing, we can expect to come back, but always, if you like, in a secondary role to gold. In terms of how it's likely to progress relative to gold, I think that with gold currently trading at £2,700, $3,700, whatever, I think individual investors probably think, oh, we've missed the boat, but they want to get in on a bull market. I mean, they don't necessarily know what they're doing. They're momentum chasers, let's face it. So I think they would see silver as a cheap way in. And there is really very little liquidity. I mean, free liquidity. If you look at the stocks in the vaults, yes, there's lots of silver there, both in the COMEX vaults and also in London. But you have to ask yourself how much of that is actually available for settlement in the market, as opposed to sitting there hoarded with a final use, industrial use, whatever, because companies consuming the metal, they're not going to take the metal out of vault storage until they really need it. And I think that's something which, is an important point. So with this lack of liquidity, I think even a relatively modest increase in ETF investment could actually put a huge great squeeze on the market. So I think as gold rises, I can see silver rising considerably more rapidly. I think in the process, the gold-silver ratio could easily fall down through 50. It's currently around about 86, 87, which implies a very substantial outperformance measured in fiat currencies compared with gold. Yeah, sure. I think, to call a fall in the purchasing power of a fiat currency inflation actually is a misnomer. There are two ways in which a currency can depreciate. The first is the obvious one, which the monetarists will tell you, and that is that if you increase the amount of the currency or the amount of credit in the currency, you will debase its value. That is undoubtedly true and holds for what we might call normal times. But there is another factor, and that is faith in it, because there is absolutely no anchor at all to the value of a currency other than its users' faith in it. Now, if the users of a currency suddenly sort of question its value, then that can have a very, very violent effect. I think what we're seeing is the buildup of violent effects. We've got a huge, great overhang of dollars in foreign hands, which are being held unnecessarily. And not only that, but in recent months, China has begun to formulate the way forward for its currency being, if you like, the equivalent of the dollar, the reserve currency for the entire Shanghai Cooperation Organization and BRICS. Now, that does mean that the rest of the world has got surplus dollars. The only other reason that they've got dollars, basically, is they're speculating in US equities. And according to the US Treasury's tick figures, foreign investment in US equities is in the order of $15.5, $16 trillion. I mean, that is huge. Now, that's all fine and dandy when things are going well. But as soon as they start turning down, those dollars get sold. Now, we are in a debt-cum-credit bubble, and it is the largest bubble in history ever recorded. We have exactly the same conditions that we had, but more violently so, in 1929 and 32, when you had a combination of the roaring 20s debt bubble, debt-cum-credit bubble, and at the same time, Smoot-Hawley Tariff Acts being brought in by President Hoover. Today, we've got exactly the same condition, but it is far larger. And sooner or later, that bubble's going to burst. And I don't know that it'll stop at a 90% loss for the S&P, which is what happened in 1929, between 1929 and 1932. That we've yet to see. But there is no doubt that there will be massive foreign selling or attempted selling to try and avoid those losses. And at the same time, they're invested in US Treasuries. And guess what? The US Treasury is in a debt trap. That is going to become even more apparent as the economy slides into recession, because the tax base that in theory covers the financing cost of the debt is diminishing. Classic debt trap. So you've got increasing risk as far as holders of dollars are concerned. So what do they want? They want higher protection. That basically means higher yields along the yield curve. And it's not just America in this crisis. When it comes to the debt crisis, virtually all the G7 are in debt crises of their own. And it's really a race as to which one gets into trouble first. And I think the dollar is the most important one. So I tend to focus on that. Now, we can see that there are gathering forces driving the dollar down. Now, when the dollar goes down, what that means is its purchasing power falls. And as that purchasing power falls, it will be reflected in higher prices. That is the fundamental problem. The Fed is ignoring it by cutting rates. There's no doubt that a quarter-point cut was politically motivated and was a compromise. I understand that Stephen Mirren was the only FOMC appointee who voted for a 0.5% cut, which doesn't surprise me at all. But you can see that the political pressures on the Fed make it impossible for them to keep an eye on the dollar. Not only that, but Mirren and also President Trump have said they want to see a lower dollar, lower interest rates, etc. They are winning that argument. And it is a surprise to me, really, that this hasn't been, if you like, understood by markets, and particularly foreign holders of dollars. But they will sell, and they will sell huge quantities of that. There is no doubt. As I say, you've got these two basic reasons. You've got the problems within America, which are driving the dollar's purchasing power down. And you've also got all these footloose dollars held by foreign governments who are moving away from the dollar. And if you want confirmation as to exactly what central banks think, they say they're buying gold, but actually that's the wrong way to look at it. They're getting the hell out of dollars and euros, I guess, as well. So what do you go into if you get out of fiat currencies? Well, the answer is real, legal money without counterparty risk, which is gold. And that basically is the situation today. Sorry, that was 130 trillion. And just for to make it clear what how these numbers originate, you've got $40 trillion of financial assets and deposits. In other words, that's the bit that's recorded by the US Treasury. But because of the way in which foreign exchange markets work, if you sell one foreign currency into another, which is not the dollar, basically you sell currency A to buy dollars, and then you sell dollars to buy currency B. The result is there is a floating mass of dollars, which the Bank of International Settlements estimated to be in excess of $80 trillion. And then on top of that, you've got the euro-dollar market, which is an offshore market not recorded in any figures of the US Treasury, and that's a further 10 billion. Add them all up, and you've got 130 trillion. Sorry, these are all trillion, these numbers. You've got 130 trillion in foreign hands, which, as you're highlighting here, is over 4 times the size of the US economy. So, there is little doubt in my mind that the potential is there to absolutely crush the dollar. And, where does it stop? I mean, the only way it stops is if the authorities have the political mandate to stop it. And they don't. I mean, for a start, the politicians, in the form of Trump et al., are spendthrifts. So they would have to do a complete volte-face. And secondly, they're elected by electors who have always got their hands out for subsidies or support of one sort or another, and all the lobbying interests and so on. Washington is built on that, just the same as Whitehall is built on that. So this is this really is something which will require a huge, great reversal, if you like, of political. The Overton window, as people say, which is why I always say it is crisis first and solution second. But having said that, I don't know that the solution actually is going to be right at the outset. This is something which, major crisis, they may be able to stop it temporarily, but I think now things are built up to the point where it's really virtually unstoppable because of US international policy. When it comes to dealing with China, Russia, Shanghai Cooperation Organization, and BRICS. I mean, China alone, its economy on a purchasing power basis is over 30% larger than the US is. And it's got the technology. I mean, the consumer technology coming out of China is really remarkable. It's very much the world leader. And what Trump is trying to do is to protect old technology in the United States. Chevrolet motor cars and things like that. So the contrast is vivid, and the loser in this undoubtedly is going to be the US dollar.
You and I like to look at things in terms of gold because it's the best measure of value for the last few thousand years, and it still is. But in 1929 to 32, when there was the crash, the dollar was as good as gold. So if you look at the stock market today, you look at the Dow, the FTSE, you see the headlines, all-time highs, but you put it into gold and they're all like tanking. So my question is, do you think there is a danger of a melt-up in the stock market only because the currencies are going to be looking so bad? Because in your piece, you think there will be a credit bust and the stock market will drop as well. And if that were to happen, how would the gold and silver miners do in that situation? Because I expect if the dollar tanks and there's a credit bust, that gold will go through the roof.
Well, first of all, as to whether there's a melt up, we've had something of a melt up. We don't know, until it happens, whether the melt up has got more to go. It is not unusual for the Fed to be cutting interest rates at the wrong moment in the cycle, if you like, in the credit cycle, and give the stock market an extra impetus upwards. So I don't rule that out. I just say that anyone sitting on, stocks and all the rest of it should realize that they are incredibly overvalued. I think the thing that will tip it would be a rise in, the two things that can do it, a rise in the yield on the 10-year and also longer maturities, treasury maturities. The 30-year is basically ready to break out on the upside. And when it goes through 5.1%, something like that, then hold on to your horses. That's going to be, the bear market resuming in style. I think the second thing is we look at the dollar. The dollar's trade weighted is knocking into, lower ground the whole time. And if it breaks the current level, which is, roughly 97, 96.8, something like that, if it breaks that, then the chart tells us that it is going down and down and down. So these forces are just waiting, I think, to trip up markets. Your comment about mines, I think, is interesting. We haven't had the great rotation out of industrial equities and maybe tech stocks into the mining sector yet. Mines so far have, rather like gold, reflected the prospects, if you like, for what's happening, rather than being driven by actual, investor asset reallocation. And I think the good thing about mines, I wouldn't restrict this just to precious metals, but also base metals, is that I have no doubt that China's plans for the SCO and BRICS, really what we're talking about is a new industrial revolution for the underdeveloped world. This is going to have an enormous impact on demand for commodities and so on and so forth. And at the same time, if you can see a fall in the purchasing power of fiat currencies, then you can, without too much stretch of imagination, see both base metals and precious metals going far higher. And that's obviously very good for miners' margins, so long as their costs don't rise at the same pace, which I don't think they will. And as I say, the underlying situation is that we have yet to see, if you like, investment flows really going into the sector. That is ahead of us. So I think I can imagine enormous gains in reasonable mining prospects. Not that I'm in the business of giving investment advice, but I'm just stating the facts as I see it.
Do you think the other nations in ASEAN or BRICS, they would also kind of add on to their gold and have more of a 19th century style gold standard? Maybe because China realizes that being the sole gold power like the US was after World War II would be a problem, like a Triffin's paradox.
Yeah, basically, I think China's approach is rather different. Well, I think effectively, both China and Russia don't interfere with individuals' currencies, countries' arrangements, political currency, whatever. You know, if the Iranians want to use, the real, and it goes down and down and down, that's their affair. But when it comes to settling international trade, obviously what governments will want is they will want a currency which retains its value. And for that to occur, you've got to have that currency tied to gold, which, as you said earlier, holds its purchasing power over millennia. It's also, incidentally, the legal final settlement money since Roman times. And of course, all the nations that went round and colonized the world with their colonies and dominions and so on and so forth were basically European, which evolved out of Roman law. So, it doesn't matter what the Americans say, that gold is a pet rock and all the rest of it. I mean, they are denying the legal position and the relationship between gold and credit. Credit has to be secured by that final settlement value. I think, individual countries, I think they'll probably find themselves quite quickly beginning to see, well, how can we stabilize our currencies? Because, if your trade is going on in something which is firm, you begin to sort of question the consequences for your own people. Not least because if the dollar, we're in a dollar-centric world. There's no doubt about that. If you don't detach your currency from the dollar, it'll go down with it. And this is going to be a huge problem, I think, for a lot of nations. They could take the view, let us say, that entrepreneurs took in Germany in the 1920s, that a depreciating currency was extremely good for their business because they were manufacturing or selling services or whatever out of a cost base that was going lower and lower and lower, and earning foreign exchange in form of gold-backed yuan instead. They could well take that view. But I don't think China and Russia feel that it's their business to interfere with internal arrangements for the various members.
Yeah, you mentioned the fact that gold is final settlement, and I'm sure you heard of John Exter. He wrote in 1972 that we now have I owe you nothing's currencies. And so we've had 54 years of where there's no that hasn't been extinguished, and I think that's the reason why we have such a big bubble. And it's amazing that people don't understand that we don't really have real money. But anyway, Alasdair, any final words for the viewers? And also, yeah, I actually wanted to ask you final words and